So I like to just start almost every presentation off with this, because what we're talking about is the voluntary carbon market. And when talking about the voluntary carbon market, one of the biggest questions that everyone asks is it actually voluntary? And so the voluntary market, right, is this something that we're building all this infrastructure for that's eventually just going to go away as corporations decide that they don't need to hit net zero anymore? And so if you look at where the voluntary carbon market gets its legitimacy from and where it actually is stemming from, a lot of that comes from investor pressure. And Larry Fink, which is the CEO of BlackRock, has this great quote basically saying that every company in every industry needs to be transformed into a net zero world. And do you want to be a leader in that or not? And so you're sort of seeing the opportunity now for corporates and people in ReFi to be a leader in offsetting. And in fact, the biggest opportunity that we have as an industry, Web3 in general, is to actually be the leader in sustainability and offsetting, and to actually be the first industry to be entirely climate positive. Obviously, with the recent merge from Ethereum proof of stake, you now see the footprint of the crypto industry, diminish dramatically, and that's going to continue as more and more projects build offsetting directly into their projects. You saw a presentation earlier with Klima where they're talking about directly how SushiSwap now you can automatically offset things immediately as you do it. And so that stack, those innovative use cases and those ways for carbon credits to grow and be used on chain is going to continue. So we all sort of know that and this is probably, I'm probably the third or fourth person today to put up a stat that looks like this, talking about the size of the market and how big this market's going to get. The voluntary carbon market is getting bigger. It's already sort of doubled and tripled in size in the last few years, and is continuing to grow and get bigger sort of every year. And there are different studies that have come out with how big that market's going to get. But basically, if you look at the size of the overall market over the course of the next several decades, you're talking about trillions and trillions of dollars in funding that needs to be directed into projects that are removing or storing carbon. And that capital has to come from somewhere. And one of the best ways that we have right now to do that is the voluntary carbon market, where we sell carbon credits to corporations who use them to offset their emissions, as well as individuals who can offset their emissions. So the market itself is incredibly inefficient. There's a lack of liquidity, there's a lack of transparency, there's tons of middlemen who are value extractive along the way. The sales cycles for corporate is very difficult. I've heard a couple of presentations where people have dove into these today, so I won't spend too much time on that. But it's a market that is also closed off to retail buyers primarily, and it's difficult to secure financing in this market today because of all of these inefficiencies that exist in the market. Actually financing new projects is incredibly difficult. So I'll quickly just talk about what Flowcarbon is doing, and then I'm going to move into how all of this sort of fits together across the value chain in the carbon markets. So Flowcarbon is focused on three things. The first is building spot market infrastructure, taking existing carbon credits that currently today live in SQL databases, bringing them on chain where they can be transparently traded and you can have real price discovery for the first time. We're doing that by building a two-way bridging mechanism and creating all of that on and off chain infrastructure to allow that market to develop on chain. We're also active in the forward market, and we're building structured products because, again, if we're going to see trillions of dollars transact in this market, they have to be financialized dollars. They have to come in the form of structured products and in the language that the financial markets understand. And so that's the other piece of it that we're building. And then the third one is, how do we get all of the current users of carbon credits to come and do this on chain? We're building out a corporate sales team that actually goes out and meets customers, meets corporates today where they are, with the intention of moving them on chain in the future as the market develops and the on-chain infrastructure gets built out and becomes the primary trading venue for carbon credits. So Web3 really does excel at solving coordination problems. Climate change is a massive coordination problem. And one of them, as I said, across the value chain, even people who are technically competitors in this space are all working together to build an entire value chain out that solves a real world problem and does it using Web3 technology in the backbone. So this is to us what the Web3 stack essentially looks like when you build the whole thing out. You have to start with project origination. Projects need to start somewhere. Somewhere has to go on the ground and say, okay, here's an opportunity for us to remove carbon using nature-based solutions, using tech solutions, using whatever solutions there might be. The second step is financing. Those projects have to get money in order to be done. The third step is actually certifying and monitoring, reporting, and verification of those projects. This is probably the hardest piece of the puzzle, and the part that is actually so ripe for blockchain technology. Because at the end of the day, what is a carbon credit? It's literally a series of data that we've now stored in a database and said, this is a credit. It's basically backed up by a long string of data. That's a really good application, obviously, for blockchain. Last, you need to have an accessible market where these things can trade. And then once you have that accessible market and you've built out sort of these money Legos in the form of carbon credits, you can build out a ton of innovative use cases where people can do things with carbon credits that previously were unable to be done before. Just to highlight a few of these, and then I'll jump into going into each one of these parts of the value chain. You have companies like C-Charge, which are going to use carbon credits as rewards. You have NFT platforms that are going to offset in the background and sell NFTs that basically solve offsetting problems for corporates and individuals. You have wallets like Fly Wallet that's just going to offset and allow that transactions in the background, similar to what SushiSwap is doing, and Fly Wallet as well as offsetting flights immediately using on-chain carbon. So let's first go into origination. Origination, I'm going to split this into two categories. One is the traditional project developers. These are the people who have been developing carbon projects for years in an off-chain context, and then on-chain development. So Alcott, for example, Flowcarbon recently announced a partnership with them, as did a couple other Web3 companies. Alcott is a traditional project developer that's been around for decades. They're looking to Web3 to move the entire value chain for creating carbon credits on-chain, and are looking to do we're doing a pilot project with them where the entire project is going to be built on-chain. You then have things like Green Trade and Ivy who are doing Web3 first project development. They're going out, sourcing projects, saying, we're going to help you find funding. We're going to help you find that funding in a Web3 context. So these are people on the origination side that are building out the first piece of the stack. The second piece of the stack is project finance, right? How do you get funding to these projects? So there's two things that are really interesting. One is these projects, most carbon credits start their life off as a forward contract, meaning that I, as a project developer, went into a place, did something, or I'm going to do something that's going to cause carbon to be sequestered, but I need capital now. And so what I do is I sell the credits ahead of them being issued. And by selling them ahead of being issued, I have capital that I can go and actually use to keep the project going and go to the next phase of the project and actually get that carbon sequestered and to keep it in the ground forever, or at least 100 years, hopefully. And so what we've done with that is we've said, okay, let's actually take those forward contracts, which are a common tool in the OTC market where people trade these credits, and let's make them more available to investors in a format that they understand. And so what we did was we partnered with a protocol called Centrifuge. Centrifuge basically uses cash flow generating assets to create a structured financial product with two different investments. So you can either invest in the drop or the tin. The drop token is essentially a debt token. It gets paid a fixed rate of return. The tin token is essentially the equity tranche of the investment. So what would happen is a contract goes into this. That contract eventually then issues credits. Those credits are sold into the open market. That money is delivered back to a smart contract, and that smart contract executes against a waterfall. So the investors in the senior always get paid back first. The juniors get paid back second, but the junior has a variable rate of return. The seniors, unless the entire thing goes to zero, the senior will always get paid back functionally the same amount, right? Think of it as you put $100,000 in, the interest rate is 10%. After a year, you're going to get $110,000 back. The junior, on the other hand, has a variable rate. So if carbon credit prices go up wildly, the junior makes a lot more money. If carbon credit prices go down, the junior can be impaired. So that's the idea here. This gives people the different abilities to invest in these projects. And then furthering the ReFi stack, you have protocols like Solid World, which are being developed to build out liquid markets for forward contracts. And so the way that that works together with Flowcarbon and the centrifuge pools that we're creating is you have people like Alcott, Green Trade, Ivy, putting projects directly into the centrifuge pools. Then those contracts can, if the pricing is correctly done, be sold out immediately into the Solid World liquid pools. And then that capital goes back in to invest directly back into more projects. And that cycle repeats itself. Thus, more and more capital gets invested back directly into projects. And then those things become available for sale in various different ecosystems and on various different platforms like Senken. So digital monitoring, reporting, and MRV. This is sort of the real heart, the meat and potatoes of on-chain carbon credits, because this is where the real data comes from and the real issuance of carbon credits exists. What's happening today that you're seeing is the gold standards and Veras of the world, who are today the issuers of carbon credits. They are the people who today are the gatekeepers to what is and isn't a carbon credit that's largely accepted by the market. They are in the process of evaluating how to move these things on chain. But at the same time, there are lots of Web3 native startups that are actually going a step further and have already issued carbon credits on chain. And the way they've done that is by collecting the data that goes into a carbon credit, having a validator who comes in and basically validates the information against the methodology, right? So the way a carbon credit works is there's basically a policy that says, if you do X, Y, Z, you then get carbon credits, right? It's obviously much more complicated than that, and there are a lot more variables, but it's all about basically taking data, applying it against the policy, and then having credits issued. That's a really, really good function for a smart contract and a policy framework that can be developed on-chain. So you have entities like Loam, Declimate, Open Forest Protocol, and Regen who are issuing carbon credits and basically bringing that digital MRV on-chain by storing that data on blockchains, which is sort of gets us to our next step is where is that data being stored, right? And so that's where you have protocols like Hedera, which operate like the Guardian, which is just a policy framework for you to actually build your methodologies in and apply your data sets to. Then all of that data gets stored by our lovely hosts on Filecoin. So the on-chaining process, this is one of the pillars and where Flowcarbon is also working, is to bring these credits on-chain. And the function that we do, and obviously we're all working towards and building towards a world where these things are natively issued on-chain, but right now they exist in the registries and SQL databases and have to be bridged. So the way that we bridge them is we bring them on-chain as individual projects. We then bundle them to create standardization across different projects. So things like Red Plus, ARR, Cookstove projects, those all would get bundled together because they should trade in similar price bands to each other. And then you have the ability to take them back off-chain, retire them directly off-chain, redeem as taking them back off-chain, unwrap them from one bundle to put them into another bundle, or you can just hold them and basically look at them as an investable asset. So this is additionally what we're talking about in that entire process. What you can see here is we create the bridge, bringing the projects on chain. Those are held in custody essentially at the registry. We then issue the individual tokens against them. They get bundled. Those bundles then trade freely, and they can be financialized on Coinbase, SushiSwap, et cetera, as well as then brought into all of these innovative use cases that now have the ability, because they're Web3 native entities, to use the carbon credits in whatever way they please. And the beauty of this is that because it basically limits your creativity to where you can go. So you can imagine all sorts of metaverse games that people create that are like play to save the planet. Instead of play to earn, you're actually using that to go and retire carbon credits in the background. So all of this, in the end of the day, the goal is to direct money to go back towards projects that are doing the carbon abatement and the carbon sequestration, and to do that all in an on-chain context.